For our final Chapter 2 conversation, we're going to have a discussion about farm profitability and compare that with the net worth of farms, and then go ahead and see at the very end how much of the overall finances does the farm sector really receive. From this slide, we can see there's three major terms that we're trying to calculate when we take a look at the gross farm income. The gross farm income is when we take the cash receipts from the farm and add to that any kind of government payments that the farmer may receive. In the dairy industry, that may be some milk subsidies, and then any other income from farm-style sources. You add those three things together and we will achieve the gross farm income. Now, the gross farm income is just the money that has came in, and that's really about all. Bills have not been paid. Once we start to go ahead and calculate the amount of our production expenses, the value of our labor, the value of the water, the seed, the feed, whatever our production expenses might be, we can go ahead and take the gross farm income minus those production expenses, and then we'll have the nominal net farm income. Now, if you recall, the nominal net farm income is the accurate income that came in on that year. If you're trying to go ahead and compare the nominal net farm income, how well we did in 2020 to how well do we do in 2015, it's really challenging because the prices of some of your inputs of production may have changed. So really we need to go ahead and apply to it a broadly based price deflator, also called an index, like the Consumer Price Index. So if we have our nominal net farm income, divide that by our index, we'll receive the real net farm income. Remember, this is the farm income that has been adjusted for inflation. So you probably want to make some time and think through these equations and make sure you understand the individual components as well as how to calculate them yourself. When we look at the financial structure, really what we're taking a look at is what is the net worth of the farm. And to go ahead and calculate net worth, you can go ahead and take the value of the real estate assets, how much is the land worth, how much are the greenhouses, the factories worth, add that into the value of non-real estate assets, how much is the machinery worth, how much are your tractors worth, how much hay do you have in the barn, and then you may also have some financial assets. You may be receiving some interest from different financial accounts. But when you add those three together, you'll receive your total assets. Now, your total assets really isn't how much you're worth, because perhaps you have some liability. Perhaps you have some loans and you have some debt out. You may own the bank for some tractors. Once you take out your debt and you've calculated the debt portion, that is subtracted from the total assets and you'll yield your total equity or net worth. So oftentimes people in agriculture will seem like they're doing very, very well, and they'll say they have a very large equity. But if they have a very large equity, it's probably because they have some quality assets. And we recognize these assets, and in particular the real estate assets, are what are allowing agriculturalists to have a lot of net worth. They may not be very profitable, but because their real estate is so valuable, they may have a large net worth. Over time, we can see how the gross farm income and production expenses has increased. And thankfully, over time, the income has been higher than the expenses. And so at one point in time, the production wasn't very high, the income wasn't very high, and you can see the amount of money, the profitability back in the 60s wasn't very high. And when you compare that to some of the profitability later, you can see that agriculture has become more profitable over time. The financial structure, however, shows a different story. When we go ahead and look at the net farm income and then adjust that for inflation and find the real net farm income, we can see the net farm income appears that in agriculture there is an upward trend in the net farm income. However, when you adjust that for inflation and take a look at what is the income over time, there's really closer to a slight down trend once the farm income is adjusted for inflation. So I think that's one of the bigger pictures we have to say, yes, agriculturists are making nominally more money than they've ever made in the past. However, once that amount is adjusted for income and adjusted for inflation, it's not quite as strong a financial picture. The cash receipts from the farm sector have gone up over time, and really farmers have not had a lot of participation in government programs. We can see here one of the biggest changes is this idea of real estate assets has increased over time, and agriculture has a lot of value, has a lot of equity, but a lot of that is because of the real estate and the value that's happening with our real estate assets. Land is very, very valuable. When we take the assets and liabilities, we can see that the farm assets have increased with the blue line going up over time. However, in the last several years, liabilities have begun to increase as well. So while assets have been positive, liabilities are also beginning to increase. But remember, the big separation between these two is predominantly because of the value of agricultural land. Equity in agriculture has been going up over time, and that's a positive. Now, just kind of recognize that the nominal net farm income certainly has increased, but not nominal farm income is not the same thing as income that has been adjusted for inflation. So it's important to understand which one we're taking a look at. Always make sure when you are comparing, understand, are you trying to compare what happened this year compared to another farmer with what happened this year? Or are you trying to compare over time? And once you're comparing over time, nominal numbers do not work. On a positive side, we can see the debt to asset ratio is low, meaning that the blue line is suggesting that we have less need for financing. More banks or more agriculturists are able to self-finance and therefore limit their interest payments. That's a positive idea, and the same thing's happening on the equity side. And when you consider yourself in agriculture with the commodity that you are going to produce, just take a look at what the real costs are. And so feed is a very expensive amount. We can see labor typically is about 8.6% of the overall price as an input. Fuel is not very significant, but wow, the chemicals, the fertilizer, and if you're paying close attention to this, you'll note one item that's not included here is the cost of water. And the reason why the textbook did not include it is because nationally, some farms will dryland farm and not have a water cost at all. While here in California, we do very little dryland farming. A lot of ours is through some modern irrigation, so they did not include the water input here, and it can be significant. And oftentimes in California, it certainly is. This is an interesting piece of information for you. Just recognize that once the commodity leaves the farm gate, we can see that over time, the overall share of the food dollar, restaurant industries, at least before COVID, have received a significant share, pretty dramatic. In 1955, they received about 25% of the food dollar. And now today, or at least with our latest data in 2014, it's 47% of the overall dollar. A pretty significant increase. And I would guess, as you could probably guess, in the year 2020, the number is probably going lower. This is a phenomenal piece for you and I to get our brains around. And this is an area that I'm pretty proud of in terms of agriculture. When we take a look at the amount of money that people spend on their personal income on food over time, it has decreased. Back in the 19s, 13.2, now close to today, about 11.2. That's 2% cheaper. And just recognize when you take a look at the axis, it starts at 10.8, and so while this is a decrease, it's not significant compared to the size of what the graph may indicate. But recognize in other countries, individuals will spend 85% of their income on food. And that leaves 15% left over for things like housing and investments and anything else they want to buy. And here in the United States, it's also great to understand and recognize that as people make more and more money, they tend to spend less of that on a percentage basis on food. And we can illustrate that pretty easily if we took a look at the place of poverty here in California, which is about $25,000, or roughly $2,200 a month. If a family has $2,200 a month coming in, how much do they spend on food? That I would imagine they may spend as high as $500, $600 per month on food, which translates to about 25% of their overall amount. And it may go lower, and I'm speaking in generalities. This is somebody that has a income of about $2,000 per month. And then when we look at somebody like, Bill Gates, Zuckerberg, people that are worth billions of dollars. When we take a look at the gentleman who owns Amazon, Jeff Bezos, his monthly income is approximately $25 million. And of that $25 million, how much can he really spend on food every single month? Let's just say we went crazy and Jeff ate out a lot and hired in some fantastic chefs, and let's just say he spent $1 million every single month on food. If he spent $1 million of his $25 million, he would invest about 4% of his income on food. And Engel's law suggests the more money you have, the less you end up investing on food. And finally, as we tie up, just recognize beyond the farm gate, the vast majority of the money that is spent goes on the marketing share. The farmer receives about 17.2% of the overall amount of money that is spent, and other people, whether it's transportation, whether it is the miller taking their wheat, the baker making the bread, they tend to have a marketing share much, much larger of that food dollar. And if you're curious, this area will break it down a little bit more in terms of what the percentages might be. But the farmer is typically somewhere around the 20% area. This is the end of the notes for Chapter 2. Hopefully they have been helpful as you guys have done the reading and looked over the complete PowerPoint in preparation for our first test.